Okay, welcome to the Swing Trading with Cycles channel. This is a special edition. We're going to talk about how to spot a market bottom. Also, same category of how to buy the dip after the thing stops dipping, right? And so to do that, you need to understand what a swing low is. And if you're watching this video, I'm hoping that you've already seen the video that talks about what a swing high is. That's how to know that an asset or a market has topped out, right? Which is to say, it's made a high and now it's declining. And so you'd probably want to get out depending on the time frame that happens in. And in that video, we actually used the 1929 crash as your example, where we had that 90% drawdown in the Dow. This drawdown here, this is that chart of the Dow of the Dow here going back to 1896. So we're talking about data, a very, very long time span. And so if you haven't seen that video, definitely take a look at, there's going to be a link in the description, and you should also see something come up in the upper right-hand corner to give you an opportunity to look at that video. I definitely recommend looking at that video first, understanding that, because I'm not going to go through swing highs as deeply here. I'm going to focus on swing lows, which is how you identify that a market or asset has stopped going down, right, and is starting to go up. It's how you identify an early uptrend. It's how you get in early. Doesn't matter what the asset is, and that's the beauty of price action. This works for any asset, whether it's commodities, stocks, anything that trades with an open, high, low, close, as I talked about in the previous video. That's this data here, open, high, low, close. This data here is all represented in these candles, right? And so these candles are just a visual representation of that data that's in that spreadsheet. And this, you can see these are the numbers, obviously. It's just easier for us as human beings to see the patterns, whereas a computer would be using that data set, right? And so let's talk about what a swing low is. This is your chart I talked about. I just referred to Dow Jones Industrial Average going back to 1896. And you can see here, this is an annual chart, meaning every candlestick is an entire year of price action, so one full year. So this big one that should stick out to you like a sore thumb, that is the year 1929. So that's the price action of 1929, right? And as I said in the previous video, definitely make sure that you're up to speed on how candlesticks work. That's just kind of a core sort of principle here. And so we'll first take a look at what this looks like with just the swing lows, right? So these are your swing lows. These are your major low points, and this one should stick out to you, this one here. And what you're going to notice, I'll flip to the next screen, is that swing lows and swing highs work together, right? In fact, that's how the market works. It's an endless string of swing low to swing high to swing low to swing high on every single time frame, right? Think about that for a second. That's the whole market on every time frame, bouncing from swing low to swing high to swing low to swing high, right? And that's the trending that we talked about in the previous video. This idea, like in an uptrend, we're doing something like this. And this is jagged, so, forgive me. But, these are your swing lows, right? These low points that a new rally is ready to start, right? That's ideally where you want to get in. Now, you're not going to be able to predict that in advance, like, oh, this is when the swing low is going to happen. But you can recognize it after it happens, and you can get in early. That's the point. That's how you time the market. You don't have to predict it. You can identify the trend reversal early, and that's obviously, this is an uptrend. There are going to be downtrends as well. In a downtrend, you probably don't want to be buying a swing low because it's just going to head to lower lows, right? So in this case, these are your swing lows, right? This. And of course, you did get a rally after the swing low, but notice every rally ends at a lower point. That's called a lower high. That's the downtrend. And so you just don't want to be buying in downtrends in general, as a general rule. So you can see this is your swing low here, and that's your rally from the swing low. This is your swing low here. That's your little rally. It's pretty short. This swing low had a pretty monster rally, right? This is your swing low off of the global financial crisis. I mean, look at that rally. And that's the way to think about it, right? After you have a swing low, the swing low is the beginning of an uptrend. So it's then a question of how long is that uptrend going to last, right? And of course, as I said, each candle here is 1 year. So these swing lows, this is another nice swing low that just kind of ran for a while, right? Without making a lower low. That's impressive, right? And so let's add the swing highs back in. So now we're looking at the swing highs. Well, let's look at just the swing highs by themselves, right? And you can see the swing high is just a counterbalance to the swing low. This is your swing low, right? So it went from, so you go from swing high to swing low to swing high. This is actually a swing low as well. So we'll just add them all together, right? So you go from swing high to swing low to swing high to swing low, to swing low to swing high. You can see the market is just kind of zigzagging. In a way, you're kind of you're adding that structure to it that we just kind of manually drew, if that makes sense. And so that's how you spot a market bottom, right? And so let's use the global financial crisis as our example this time. We used the 1929 crash, but we looked at, like, how would you identify the actual levels, right? And so let's do that. And again, we're going to look at it top down. So we're starting with the annual chart, right? So this is your global financial crisis. We talked about this being a swing, this big candle being a swing low. But where does a swing low actually activate? It's above the high of the candle that marks the low. So it's the exact opposite of the swing high. The swing low is activated once you get above the high of the candle that marks the low. So this is the candle that marks the low. Again, we're looking at the global financial crisis here. So the low for that candle, and you'll always see that up here, is 64.69.95. So let's just call it 64.70, right? 64.70. And so that's your low, and the high is 10,580. So that's a pretty big bounce within that year in and of itself. And so when we zoom into lower time frames, you'll see how you could have caught the move earlier. But if you take this at face value, once you get above 10,580, once this candle does that, I should say, just to be clear. So this is the year 2009 when the market bottomed. So once the 2010 yearly candle, the annual candle, goes above 10,580, you have a yearly swing low in place. And you know that this is probably a major bottom. Now, this can always reverse. And that's why it's one question I get all the time. Does the candle close matter? And the answer is always yes, absolutely. And the reason is very simple. It's because candles transform while they're forming. Like while they're forming, they're going to be transforming. And so you have to wait for it to close, or at least until it's about to close. And so there's not likely much more that could happen to it. So this is a perfect example. This year, 2009, at one point, this candle was actually very red. We know that because of this lower wick here, right? Because this candle opened here, right? So it opened at 8,772. And we know the low was 64.69. So think about that. If it opened at 8,700 and we know the low was like 6,500, that means at some point it dropped from 8,700 to 6,500. So it was a very deep red candle. It was scary because we were also making a lower low below this candle, right? So like, just to not to belabor the point, but I mean, and we talk about this in the previous video, you see. So we were doing that, right? So like, this became a really ugly swing high like this. Like, it's like, uh-oh, are we going to decline much further? But then we reversed violently. And I know that it happened violently because of the wick. The wick tells you there was violence, right? That wick is price rejection, right? That's the price getting to that low level and then just saying, no, I'm going in the other direction, right? And so that's what happened here. And then it went from red to green, right? By going above that open price of 8,772. And we know that the high was 10,580. And it looks like it closed at 10,428, 428, right? So it closed at close to the highs. So that's all really important information, and that might not all make sense to you just now. You may have to rewatch this, but and as we go to the lower time frames, you'll start to see why this is all significant. So this is the yearly candle that we're looking at. What happens when we zoom into the 6-month candle? Do we get a different trigger? Absolutely, we do, right? So now the swing low is this candle here, we can see, right? This is the first half of January 2009, or excuse me, the first half of 2009. That makes sense because we know that the market bottom was actually in March 09. So the swing low happened above the high of this candle here, if you get more precise. As you get into the lower time frames, you're getting more and more precise, and you're going to get a better price. You're going to get in earlier, right? But it also means it's more the lower the time frame, the more risky it is, the less solid the move is. So you're starting to see it's a balance of the two things. If you wait too long, like for a yearly signal, you've missed a lot of potential upside. But if you jump in too early, and when we say early, like I'm talking like an hourly swing low, that might be too low a time frame. But obviously a 6-month swing low is very significant. So that would have got you in a little bit earlier, right? So again, the high here is 9,088. So maybe like 1,000 points earlier. What happens if you get down to the quarterly chart? Not much different, right? So the quarterly chart is actually the same candle or the same level, right? So the way to think about this is these two candles combined make up the 6-month chart. So that doesn't really give you any advantage. What if you get down to the monthly level? Does that give us a little more precision? Oh, yes, it does. Look at that. I hope you're seeing that. Like this line, I didn't move it. These are now broken down into monthly candles. And now we see it's this, well, as I already said earlier, because we know just from history, the bottom happened in March 2009. I think it was the March 9th exactly. But that low, or I should say the high from that candle, from that monthly candle, was 79.31. So remember, the yearly signal came in at like 10,000. So you're now like 2,000 points lower, maybe a little bit more. I forget exactly what that number was. But that's that's important, right? Like you start to think about what is your preferred, time frame for trading. And that's how you start to identify the market bottom, right? Now, here's the thing. This candle happened, like this was a scary move down, for instance, where, like as I said about that other candle being red, this was a red candle before. Anytime, just in general, anytime you see a candle that's green with a lower wick, it means it was red at one point. That's like it had to be, right? Because it was below the open price at that point, right? And so this thing was red at one point, so that was kind of scary. But then we had this violent move back up, and then we continued the uptrend as we kind of talked about that zigzag pattern that we walked through, that we talk about. And you even had this sort of time period of, tough trading, but this was a low that was way above this one. So you were still, pretty comfortable. So that's your monthly. And if we zoom down to the weekly, does that give us a better signal? Let's see. Right. So I think, let me just make sure that this line is visible on the weekly level. Yeah, we'll turn it on. So now we'll zoom down to the weekly. Let's see. Where does that leave us? Oh, that's 2009. There we go. So the weekly gives you an even better signal, right? But again, it's more risky because the move is less firm. It's less solid. But that's why you've got to pick your, know what your risk tolerance is and use appropriate stop levels for sure. So the low actually came on a red week, which is always interesting. So, it was this week of the week of March 2nd, 2009. Again, because we know, right? So that was a high of 7,058. So not much different than your sort of monthly signal. And if we can even go down to the day, right? How did that look? And so this is the multiple time frame analysis component of all this, right? That like the way it works is that the lower time frames cascade to create the higher time frames, assuming you get follow through, right? And so at some point, we know, obviously we know that there was follow through here, but like that yearly swing low, then the 6-month, the quarterly, the monthly, the weekly, that couldn't have happened without this daily swing low. Wow, and it came with a very ugly doji-like candle, right? Oh, so it was March 6th for the Dow. That was a Friday. That's interesting. So it bottomed on a Friday. And that high was 67.55. So not too much more of an edge, really. And the next day, you actually had consolidation. And then you had this big rally. And then you were kind of off to the races. And then just like looking micro, these are little higher lows along the way, right? That's how you know you're still in an uptrend, right? You notice each of these arrows is happening at a higher point. That zigzag pattern I drew, it's not going to look perfect that way, right? You want to impose that on the chart in your mind, kind of, and that's what these arrows are doing. With time, you'll get more practice, and you'll see this starts to kind of flatten out a little bit. That gets a little bit scary, like these kind of, you could essentially draw a bunch of arrows at essentially the same level, which is not good. That's essentially a range. But that's how you spot a market bottom, and that is the key skill needed. In addition to understanding when a market is topping, once you can understand how those two are interplaying, that is a big part of this, and that's the core of what we do on this channel. So thank you for watching.